Doc. Sean Duncan with SMD Consulting and Accounting. So apparently I got some of your attention when I said investing in insurance. So let's talk about some high-level stuff related to insurance as a potential investment diversification strategy. But first, oh yeah, the disclaimers will matter. Okay, so insurance. Now, insurance is not intended to be an investment initially, but there's a whole bunch of kind of cool stuff you can do with it. So let's first talk about the differences, and I am going to make this high level because this can get wildly complicated. I happen to be insurance licensed, and just the continuing education I have to do for this stuff is kind of out of control too. So just know that I'm going to hit high points. I'm going to be missing details. So if you talk to any other insurance professional, they're going to go, hey, he missed this point. Yes, I did. It's high level. All right. Essentially, there's two types of insurance: term, permanent. Term is like your car insurance. While you're paying for it, you have it. It's the lowest cost of all of them. Its purpose is purely protection. This is the one you buy because the bank made you get an insurance policy because you had to do that for financing some loan or backing them up. You're going to buy the cheapest dang thing you need. That's what term's for. Term is the place to start. For life insurance, I want your family protected first, period, end of story. That's its purpose. I want you to make sure that in the event something goes wrong, happens to you, your kids, your wife, your husband, everybody's cool and taken care of. That's why I want you to have insurance. And term is an amazing tool, but it expires. It's a term, a 5-year, 10-year, 20-year, 30-year. Now, what's really interesting is when you want to renew it, guess what? You're also older. If you had a 20-year term that expires, you are 20 years older, which means the renewal will be much higher and commensurate with your age. Totally normal. The question comes in is like, well, why wouldn't I always get permanent? Well, while your kids are in school, you need to make sure that they're protected. Like, you need to get them through school. So a lot of people will buy a 20-year term, and then once the kids are in college or off, they're kind of on their own. They're adults, and they should be able to take care of themselves. So the need for insurance is greater often when there's children involved. It can be greater when there's practice-related stuff as well, but that's the main reason. Permanent insurance has a insurance component. Obviously, it's got protection, but it's also got an investment component, the cash value. Now, there's a lot of rules, and so I'm going to keep this simple. Essentially, you're going to pay money, and that money will be split partially toward the cost of insurance and partially toward accumulating and growing cash value. Think of it like principal and interest on a loan. They're going to pay the interest first because the bank wants to get their money, and the extra can kind of go over and work down the debt. Well, this flips it. It starts to grow. And there's a lot of variables. Sometimes your $1,000 a month premium, this month $900 of it goes to cost of insurance, and next month it's $884. That's part of why this stuff grows. And it's got all kinds of estimates and actuarial tables. But what's really neat about this is it functions a little bit like Roth IRAs, and bear with me on the comparison. It grows tax-free like a retirement account, but can come out tax-free in certain circumstances. Now, sometimes it does come out taxable, and this is where we get into the nuancy stuff. But here's the heart of it. You also have insurance that is permanent, that covers you to the age of 99 or 100. Live to 140 like I'm planning on it, well, then you've got 40 years to figure out. But permanent insurance is intended to cover the entirety of your life. If an insurance is going to cover the entirety of your life, it automatically has built in those increases in premiums you would have experienced on a term renewal, because I just told you, you're older, so it's going to get more expensive. So these things are more expensive. And just think of it from a risk standpoint. If you are a 25-year-old brand new, near baby doc, and you buy a 10-year term, what's the likelihood you're going to die between the ages of 25 and 35? It's lower than you would if you're the ages of 75 to 85. Makes sense? So essentially, they're going to charge you more because the likelihood they're going to pay you is greater. So by a permanent insurance policy, what's the likelihood you're going to die sometime between now and the age of 100? Pretty high percentage. Given that they know the likelihood of paying out is higher, the premiums are higher as a relationship to that cost. Makes sense. Just basic math, because insurance companies are really good at making money and they want to make sure they continue to make money. So that's why they do it. So the cost of the insurance is going to be higher. There's ways to pay it in full. There's ways to pay it out over a stretch of period. I have plenty of docs. What we'll do is we do what's called a 5-pay. We'll calculate what the total lifetime cost of the insurance is going to be and just pay it over 5 years. Boom, you're done. You never have to make a payment toward the cost of the insurance again. Everything else is dealt with growing the wealth. So the cash value component grows tax-free. Now, depending on what math is involved in that growth is driven by the type of policy you have. There's whole life policies, there's universal life policies, there's index universal life, there's variable, there's blah, 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 tons of these things. Work with your professional to figure out which one's the best fit for you. I have some opinions, and I'll talk a little bit about a couple of them that we like to lean on, but that doesn't mean they're the silver bullet either. But generally, they're growing at some number. The ones we use, they're called index universal lives. If you're interested, I'll talk about comparison a little bit. I have 4 of these things, and all of them have a floor. One of them has a 1% floor, and the other 3 have a 0% floor. What does that mean? They're tied to an index. They're tied to the market. They are invested, and so they will grow in a relationship to the stock market. But they have a floor. So if the market goes down, I don't lose money. It doesn't go negative. This particular type of policies that I have, they don't go negative, but they will grow. Now, in exchange for the benefit of not losing my money, there are caps. I believe that I've got 2 of them at a 12 and 1 of them at 13 and 1 of them at a 14 or something like that. I didn't memorize it, but I trade. So if the market is at 20% growth, I might only make 14% tax-free. Darn. It's not the swing for the fences thing, right? But it's also not sitting in a money market account at a bank. It sits in this space in between. And it's, again, about diversification and strategies. So this investment grows tax-free and then is available for different distributions and different rules. Hopefully that part makes sense. Now let's talk about distributions. This stuff might make your head explode, and we may need multiple sessions and we may need individual consultation, but let me give you the gist of it. Essentially, there are 2 ways to take money out of these things. One, you distribute. You just take the money out. So if I've got $200,000 in there and I want to take $50,000 out for a reason, we'll talk about reasons why these are really cool. I take $50,000 out. I can take a distribution, and it goes in, first out, which means up until the amount of the premiums you've paid. If you've paid $100,000 of premium and there's $200,000 in the account, 100 is premiums and 100 is growth. The return of your premiums is tax-free. They're giving you your own money back. Take out 110,000, 10,000 will be taxable because, well, that was based on your growth. So like I said, there's a part where it does kick in taxable, but you can take this money out and just take it. The downside to that is you've taken it out. So now when compounding happens, it's compounding on a lower base number. You can also loan money to yourself. And this is actually what I typically do. Doesn't mean it's always the right solution, but this is what I've done. If I wanted to go invest in some real estate and I want to borrow $50,000 so I can go and put some down payments on some real estate, I borrow it from my policy. The policy does have an interest rate. Depending on your policy, it might be a fixed lock rate, it might be a variable rate. The last time I did this, it was like a 4.5% interest rate. Well, I took it at 4.5%. At the time, my funds were compounding at 9-ish%. So I was, and this is back before interest rates hiked, I was still making 4.5% on my money on that segment. The rest of it was still making 9%, which was crushing leaving money in a bank account. And it was growing tax-free. Win-win. And then I took my 50, went and invested in some real estate, made a bunch of money on that 18 months later, sold it. And by the way, I'm the banker. This doesn't show up on your credit report. I don't have to go to a bank and ask permission. I'm it. I'm the show. So I can decide when I want to pay it back. Now, if I die along the way, whatever outstanding loans I have, well, that reduces my death benefit. Whatever, I'm dead. I don't really care. It's like this $1 million policy only pays $50,000 less. My family's not going to notice the difference because of what we were doing. So there's strategy on when to take this stuff out. There is a rule, though, called the modified endowment contract. This is super nerd. I'm going to keep this simple. There is a ratio that you need to have for life insurance to cash value. What they don't want to have happen is you go buy a $50,000 death benefit policy and park $7 million in there. Because now all you're doing is hiding money and you're not paying taxes. And of course, if you're not paying taxes, the government hates that. This is what was done back in the 60s or 70s. People were abusing the heck out of this. By the way, this strategy with insurance is what the ultra wealthy do as part of their portfolio. So if you're thinking about, I want to live and operate like a wealthy person, this is one of those tricks, because we're parking money in a way that's got cash value. It's got liquidity because I can get to it. It's growing and invested. It's got protections in certain points. It's cool. And if you watch the other webinar that I did, or the video I did where I was saying I can give you math on why all your money should be here, I could. But again, it's not prudent. I want you to balance your investment strategies. So life insurance sits in this unique little space. Its first purpose is for protecting you. That's what I want it for. But there are strategies where it can be an investment. Now, why did I say I use IULs? We take our fiduciary responsibility really, really seriously. And so we actually sometimes don't recommend things that are going to make us get paid the best. So the last one, we actually did this math. We were doing a comparison between a whole life policy and an index universal life policy. Whole lives work really awesome in certain circumstances, and you'll see these all over the web. One of the reasons you'll see them all over the web, and I'm going to be a conspiracy theorist, the commissions are higher. Oh, I love selling whole life policies. Make a good chunk of money. The problem is when there's a commission, there's an increased cost of the insurance, because you see, we're going to get paid. There's a lot of licensing rules. There are commissions. There's always a commission. And never hesitate to ask your person what the commission is, because if they don't tell you, it's a little weird. I'll tell you. But the commission is part of the cost. So when I was talking about part of your money goes to cost of insurance and part of it goes to cash value, well, if the cost of the insurance is higher because of the commission, your growth happens slower. So we tend to set up people with IULs or similar products like that have a slightly lower or significantly lower commission. Yes, it hurts us because we're not getting as much money, but as a fiduciary, I want you to accumulate as much wealth as you can, because this helps you and your family going forward. So it ends up in this comparison we were doing for this one doc. We were comparing and we got down into the commission load and realized we need to go the IUL route because it'll help them accumulate wealth faster. There's a lot of ways to build these. There's a lot of complexity. Like I said, I have 4 because I have 4 of them built in different ways for different goals. So there's a ton of rules. I am not giving insurance advice. I am not giving securities advice, but I do encourage you, look at this. If your financial advisor is only an insurance person, then you might be missing out on securities advice. If your financial advisor is only a securities person, you might be missing out on the insurance piece. Sometimes you'll need 2 people. Sometimes you need someone like us that does both. But I do encourage you, look at this. This is a really unique strategy. And like I said, it's what the ultra wealthy do. And for you high earning physicians, this is definitely something you need to talk about, because it's protecting your family, accumulating your wealth. And here's the last one: creditor protected. The money hiding in the life insurance is not available for lawsuit. So, hey, let's create some opportunities that fit your unique lifestyle as much as possible. I did do a lot there. That was a lot of technical stuff, but also it really was a lot of high level. If you have more questions, ask us, ask your professionals. We want you guys to have the best possible opportunities for accumulating wealth and protecting your families as possible. Thanks, y'all.